On the 9th of December 2024, we posted a video warning that the stock market was due for a short-term pullback. Since then, we've seen the S&P 500 correct by a few percentage points, and the RSP, an equal-weighted version of the S&P 500, correct by about 7%. The question now is whether we can already start being more optimistic on the performance of US stocks, or is there more pain to come before US stock market indices finally bottom out? There's two reasons for why the stock market has been declining recently. The first one is simply portfolio rebalancing. Back in early December, US fund managers had a 99% exposure rate to the US stock market. Of course, that left the market vulnerable to a decline in the event that these fund managers decided to reduce their exposure. Now, while these high levels of exposure don't guarantee corrections by any means, they certainly do increase the odds that one will happen. When we look at the stock market on top of this indicator, we see that many of these high exposure readings did precede some kind of a market correction. If we look at the most recent data on fund manager exposure, however, we see that it's declined considerably recently. And to us, this is a positive sign for the market. It suggests that the recent correction in the stock market has allowed fund managers to scale back their exposure to stocks, which is what you want to see happen during a healthy phase of consolidation in markets. Currently, fund manager exposure is hovering at around the same level as it was in August, April, and January of 2024. All of those were pretty good moments to go long on the stock market. So with this rebalancing that's just happened, we've actually gotten a little bit more constructive on the stock market today. We believe investors should start to look for a resumption of the bull market, because during this correction phase over the last month, we've seen S&P 500 earnings estimates continue to move higher. In fact, they've continued to grow at quite an incredible pace, comparable to the earnings growth we saw in the late 1990s, which was an incredible period to be in the stock market. So despite the recent market correction, S&P 500 companies are providing evidence that they are still growing at a rapid pace. So the bull market that's been in place since late 2022 is still intact, and we believe has room to run higher from here. The technical structures that we're watching on stocks are very much still pointing upwards. At the start of 2022, for example, the S&P 500's moving averages were curling downwards, and price was breaking below them, which was a huge red flag for stock market performance. We can say the same thing about the topping process in 2008, where moving averages were also curling downwards and price was also breaking below these moving averages. This bearish structure continued throughout the entire bear market of 2008. That being said, stocks may not be completely out of the woods in the short term. We're not ruling out the possibility of one final leg down before stocks resume their uptrend. And that brings us to the second main factor that's been driving stocks lower, and that is spiking US interest rates. This is a chart of the United States 10-year government bond yield, and over the last few months, we've seen this 10-year interest rate move up considerably. This is a massively important financial variable, and this recent move up is what's been driving the stock market's correction recently. Many of the corrections in the stock market that we've seen over the course of the last 2 years were driven by similar moves up in interest rates, and today's market volatility is absolutely nothing different. In each case, however, as soon as the 10-year interest rate peaked, the stock market bottomed and began a significant move higher. When interest rates on US Treasury bonds move up, it leads investors to reallocate capital from risk assets like stocks and into Treasury bonds as they see the higher interest rates as more attractive. And we think that is what's happening today. Of course, a further move up in interest rates could spark more downside in stocks, but as soon as interest rates reverse, you're going to see a violent leg up in stocks. The question now is, how high can interest rates go? At the end of the day, long-term interest rates in the United States follow what's called GDP growth. GDP growth is essentially how much the total US economy is growing each year. Right now, US GDP growth is hovering at around 5%. And surprise, surprise, the 10-year government bond yield is hovering at around 5%. Over the last year, GDP growth has gradually been trending lower. And we think there's a good chance that this trend continues, or at best, that GDP growth stabilizes at around 5%. So that means at most, the 10-year yield should be hovering at around 5%. We don't believe that we're going to see a big pickup in GDP growth anytime soon that could cause long-term interest rates in the US to spike much higher. So zooming back in on the recent action on the 10-year government bond yield, it's not impossible that we see interest rates rise a little bit more here to hit 5% or 5.2%. But that's really the maximum move up that we'd expect to see before a big reversal. So putting all of this together, we're more constructive on stocks now than we were back in December. We're not ruling out the possibility of a final move down in stocks if interest rates continue spiking before before the stock market moves higher. The maximum drawdown target that we've highlighted to our clients is 5,600 points on the S&P 500. The bet that we are more confident in the short term, however, is gold. Gold began a brand new bull market in 2024, breaking out of a long-term basing pattern. Over the last few months, we've also seen gold consolidate a little bit, but if we add some key technical levels, we see that gold has just bounced off the bottom of a key price channel. We actually sent out a few buy alerts to our clients, initiating trades on gold mining stocks that we think can outperform significantly if the gold bull market continues.